This conference will now be recorded.
Okay, guys, so as we had been working on the parts of credit risk, we had been talking about broadly about scorecards. So we we saw that we had divided the entire module into two broad parts, right? Number one is on so basically our objective is to understand how is it that the model is structured, or how is it that the data how is it that scorecards and risk models play a role in risk management, right? So we had started off with this discussion, and we had divided the data we had divided the base into two parts. Number one was the scorecards, right, and the business BAU model development and validation procedures, where we could talk about, where we had talked about the different scorecards, right? So we talked about uh, approaches like the credibility, we talked about the process of scorecards, right? So how does, at what stages of the business does scorecard help us minimize the borrowers or the transaction risk, right? And we saw that there are two broad type of scorecards that we generally work with as far as risk is concerned. So one of the parts being acquisition scorecard, and the other being the behavior scorecards, right? So while we talk about acquisition scorecard, the question comes out that why do we need an acquisition scorecard? We need an acquisition scorecard to manage the origination risks. So the risk that a borrower may have at origination. So acquisition scorecard is used to manage the origination risk. Now, when I talk about origination risk, what is it that I mean? So, what are the risks that a bank need to assess at its origination? So, this is your origination risk, right? So, origination risk, when I talk about origination risk, I refer to two broad type of questions which the bank asks themselves. One of them is One of them is that, does the borrower have the affordability to buy the particular product? Can the borrower afford the product? And the second question that we have over here is that, is the borrower a reliable borrower? So when the bank is giving out credit, the bank needs to assess both these two sources, one being the reliability of the borrower, and the second being the affordability of the borrower, right? And hence, what we have seen is that most of the variables that an application scorecard or an acquisition scorecard uses reflects either each of these two characteristics, right? So, so basically, when we are talking about origination risk, so the outcome of origination risk, or at the origination stage, there are two outcomes. One of the outcome is your accept outcome. So whether the application that the borrower is making has been accepted, or the second outcome that we have over here is whether the thing has been declined. So these are the two broad sources, or the two broad outcomes or at the acquisition stage, and this is one major reason as to why this particular scorecard is used. So this is used to take the accept decline decision into play. This is accept decline, and that is where the acquisition scorecards come into play. This is where the acquisition scorecards are largely used, right? So we are also scrutinize the different kinds of acceptance and rejections, right? And we have seen that when an applicant is rejected or declined, right? So there are two broad reasons of the declines. One is score decline, the other is your policy decline. Now, when I say it's your score decline, it means that the applicant has not been able to manage the cutoff score. So if the score of the applicant was S0, right, and the score cutoff was S bar, then S bar was greater than the applicant's score, and hence this guy was rejected. So that is something called the score declines. Now, the other part that we also need to look into is your policy declines. So, when I talk about policy declines, what are policy declines? Policy declines are cases where you are declined because you do not satisfy certain policies, acquisition policies, which are set forth by the bank. Say, for example, I may be a very rich chemical plant owner who is applying for a credit card in a USA bank, in a bank in US. Now, what US does is the US checks his monthly income and his affordability for the product and his different sources of affordability. And what they see is that yes, this guy has a very good affordability and he is a score accept, so he passes the cutoff score. Now, the next question that comes out over here is Now, is the next question that comes out over here is that when they track back his origin, they see that he is someone who has his business in Syria, who has a residence in Syria, and now, given that Syria is a terrorist-infested country, then it is sanctioned out, right? So, therefore, this is kind of so this is a kind of a policy reject. So basically, since Syria is a list of falls in the list of sanctioned nations, this guy is not given the loan. So these are the different ways of accepting and rejecting different borrowers. So even if there can be cases that a borrower has not passed his cutoff score, right, but still he's given the loan. Now, say for example, his forefathers have left huge volumes of balances, huge volumes of wealth with the bank, right? Say some millions of dollars with the bank, and now this guy he thrives on the wealth which has been left by his forefathers, and he's just squandering away those money. Now he does not earn anything, right? So therefore, obviously he would be a score reject, right? But he would be a policy accept because under certain products, like under certain very special or premier products, what we get to see is that even if the borrower does not have sufficient, even if the borrower does not satisfy the score cutoffs, they can get the loan, they can get the money if, or they can get the credit if they have substantial amount of wealth with the bank, which acts as a guarantee that even if this guy, even if some downturn happens, or this guy can pay back, or has sufficient wealth to pay off the money. So that's a case of a low score override. So where the score decline is overridden by the underwriters and they are given the product. So there are these cases of low score overrides in the portfolio as well, right? And that happens, or that depends on the specific criteria. Now just like that, you cannot do a low score override. There has to be certain criteria for doing that, right? So, what we have done over here is we have explored all these aspects of an application scorecard, and we have seen how is it that an application scorecard can be used, or rather, how is it that an application score can be used for model development purposes, or how is it that this application score that I obtained from the scorecard, how is this application score can be used to perform certain risk management exercises. Now, application score can be raised or lowered. So one thing is, what you can do is you can raise your application score, right? You can raise your cut off application score, and thereby, if you are raising this, you are raising the standards of acquisition, right? And thereby, what you are doing is you are detoxifying your portfolio. So what you are doing over here is you are detoxifying your portfolio. Your portfolio. So generally, application scorecards or application scores can be raised, right, during downturn periods, and thereby ensure a better quality of or a better overall quality of hiring. Right. So this is one way through which you can manage your acquisition portfolios, or you can manage your acquisition risks using application scores. Also, application scores can be cut down. Now, when you are cutting down your application score, what you are trying to do is you are trying to go into an expansionary mode. So you are trying to hire or onboard relatively more riskier borrower than that you were doing previously, right? So over there what you are trying to do is you are trying to expand your portfolio, means you are trying to expand your portfolio, expand your portfolio. Now, apart from these strategic exercises, the application score that we generate is also used to take other BAU decisions as well. So you can use you not only use accept application score to take the accept decline decision, but also it is used to decide on the amount of credit that is to be lent out and the price at which the credit is to be given. So those pricings happen at different segments of application scores. So application scores have a lot of different uses for the particular bank, right? So one is your accept decline decision, and the other is your pricing payoff decision. The pricing payoff decisions. So these are the different uses of acquisition scorecard, right? So we had also gone through a very typical example of an application scorecard for a personal loan, and we had seen how this decision can be taken. So how does a typical application scorecard look like? Right? So our basic objective over here was to understand the implementation of an application scorecard in risk management strategies. What are the different types of categories that are there in an so how is it that the variables are reached to in an application scorecard? How are the categories created, and how are the scores corresponding to each category given? Now over here we do not answer these questions in detail, because these questions will be answered in details as a part of the modeling exercises, right? So the very question of modeling exercise is that I start off with some hundreds of variables in the data set, but how do I reach to only these four variables, right? So that is something that we want to actually understand. That's what we want to actually explain, right? So that is what is explained by the model development exercises. So this part is after the model has been developed and after your scorecard has been finalized. Now what we have tried doing over here is to check how is it that using this scorecard, how can I take respective risk management accept decline decisions, right? And if I'm accepting it, what are the factors in, what are the key points? If I'm declining it, what are the key points? So these are something which we have already discussed, right? And how is it by changing the different problems, the different card of scores and everything, how is it that we can support the risk? How is it that an application scorecard can support the risk management strategies, right? So this is something that we have already worked on, right? So I'll not be going into it this at this point of time, but yes, when we start developing our application scorecard, I'll come down to it. But at this point of time, what we are doing is we are trying to frame an in detailed idea about how scorecards work rather than how they are developed. Because my objective is first to fix the target, right? I need to know that this is the part where I need to reach, right? The final figure that I reach to would be something looking like this, and this is how it is to be deployed. Because only when you know what your target is and how is it that you are going to use that in the next stages of the business, only then will you be able to develop a very sane kind of a model, or be it a behavior scorecard or be it an application scorecard. You'll be able to build it only then. But before that, it really looks challenging for us to do that. So therefore what we'll do is we have talked about the acquisition scorecard. I have given you the background, right? uh, so today, in today's discussion, mainly we will be focusing on the role of behavior scorecards, right? And followed by that, and that will be followed by the key steps involved in scorecard development. So this is a file which is still work in progress, right? So when we talk about the stages of scorecard development, we'll talk about what are the steps, what is done in the respective steps, what are the analysis which are performed in the must be performed in order to get those exercises that sorted out, and finally what we want to know is that what would be the key deliverables in these stages, right? So that is what we are trying to kind of establish, that is what we are kind of trying to leverage. Okay. And yes, as we go ahead, we will be kind of uh, filling up each of these cells gradually as we go ahead, right? And the key concepts that I bring in over here, right, the key concepts that I bring in over here and needs to be explained is done in over here, right? So when I'm talking about so where I'm talking about seasoning analysis, I create the concept. When I talk about roll rate analysis, I'm creating the table. When I'm talking about performance merging, I use an example and show how the performance merging is done, right? So these are the kind of things that we will be working on, and so this is how we would gradually be proceeding. So as we go on, new concepts coming in, we'll keep on updating our Excel sheet, right? So we'll keep on updating our respective tabs, and finally at the end you will have your final state of documentation, right? So is this understood? Especially Piyush and Pradeep. uh, Harish is aware of this framework because he has been doing the classes for the last couple of weeks. But so since you guys are new to this framework, so is this approach clear?
Yes,
Great.
Tanvir.
Thank you.
Yes, Tanmay.
Okay. Thanks a lot. Fine. So what we'll start talking about today is about behavior scorecards, right? Now, so what essentially is a behavior scorecard? Let's first try to understand the concept and then I'll go back and I'll explain the Excel sheet. Now, once you have given the loan to the borrower, right? So you have, say, there was kind of 1,000 applications which came in, right? As on a given date, say as on 30th October, 31st October, there were 1,000 applications. On 31 1 31 10 2018, right? Now, from here, there was 700 applications which was accepted, or say 800 applications which was accepted. These were accepted, right? and there was 200 applications which was rejected. Right? So these are the three things. So this is how the final result is. Now this 800 enters into the books of the banks, whereas where the books of the banks already had 1200 borrowers, 1200 existent borrowers, to that 800 borrowers were added in. Right, 800 borrowers were added in, and finally, as on the 3rd of November 2018, or as of November 2018, you have 2000. You have 2000 results, or you have 2000 uh, observations, or 2000 accounts. Now, for each of these 2000 accounts, what is the problem of the business now? The business has given them the loan. So whether to give them the loan is no more the problem. Now, the problem of the business is to understand the find an answer to the question that will these accounts repay? Will these accounts repay? Will these accounts repay? Now, when I say that will these accounts repay, so what is the problem that the bank is actually trying to address? So basically, I want to know, or very specifically, my objective is to answer the following question, that y equals to 1 if the borrower defaults. If the borrower defaults is equal to 0 otherwise. Now, when I say if the borrower defaults, now the question that comes out is under within what period of time are we expecting the borrower to default, right? So, does the borrower default in the next 2 months, next 10 months? So, we say that if the borrower defaults in the next 12 months, in the next 12 months. Right. Now, what is it that we are trying to do over here, or what is it that we are trying to model over here? What we are trying to model over here is the probability of y equals to 1. So that is what I'm trying to understand is the probability that a particular account will default in the next 12 months. So this is known as your probability of default, or many people call this the behavior PD, called the probability of default, or this is also called the behavior PD. is called the behavior PD, right? So over here, one thing that I have is the probability of y equals to 1, right? So the ultimate target variable over here is to assess whether the borrower defaults in the next 12 months. So what is the broad question that we are trying to answer? The broad question that we are trying to, the broad tendency of the borrower that we are trying to capture over here is the willingness of the borrower to pay. The willingness of the borrower to pay back. So whenever we are trying to, kind of model a PD, a behavior PD model or something like that, what we are trying to understand over here is that what is the willingness of the borrower to pay back, right? So at an origination stage, right, the origination risk comprised of assessing the affordability of the borrower, and at the behavior stage, the challenge is to assess whether the borrower will be, or how willing the borrower will be to pay back the loan or pay back the credit, right? So this is precisely what the overall idea is. Now the question that comes out is that how does a behavior scorecard work? How do the variables, or how would the final variables of a behavior scorecard look like? So that's the question that we are trying to answer over here. Like, what type of variables will help me successfully capture this willingness to pay back, right? And the product in terms of which we will try to assess the operation of a behavior scorecard is credit cards. So we look into the behavior of credit cards, right? Very simplistic behavior of credit cards, and from there we'll try to understand, right? And from this we'll try to understand how is it that the credit cards will actually work. Like, how is it that a behavior scorecard developed for a credit card will help me assess the behavior risk associated with the borrower, or how is it that it will help me assess the behavior scores, or help me assess the willingness of the borrower to pay back, and hence his chances of being a good borrower or a bad borrower over the next 12 months, right? So that is what we will be exploring in this particular Excel sheet. Now, just before we move on, let us just talk about the overall understanding, our overall understanding of credit cards, right? So all of us are more or less aware of what credit cards are and how is it that they work, but I'll just highlight on a key or on a few key kind of factors, right, which affects the behavior of the credit cards, right? So which would help us explain the risks associated with the credit cards, right? So let's have a look into this. So as we know that credit cards are nothing but they are simple revolving products, right? So basically, credit cards, or CC as I'll say, are revolving retail credit products. Are revolving are revolving retail credit products. revolving retail credit products, right? Now, so what are the key features of a credit card? So a credit card has two important features, right? One is the balance, and the next is limits. Balance and the limit. So limit is the maximum amount of credit that the user can have on the credit cards. So maximum, so this is what this is, the maximum amount of credit the maximum amount of credit that can be used by the card holder or usable by the card holder, by the card holder. By the card holder. So maximum amount of credit usable by the card holder, right? Now the balance is the actual amount of credit used by the card. Actual credit used by the holder. Used by the holder, right? So actual credit which has been used by the card holder, right? Now the next part that we have over here is, so over here now these are the two broad characteristics of credit cards, right? Now from these two we can actually use, we can create a very important variable which is looked into to assess the critical risk characteristics from credit cards. So one is the utilization. One of the very important variable that we need to understand over here is utilization. Now what is utilization? Utilization is nothing but balance by the limit. Limit into 100, right? So it is utilization which is balanced by the limit into 100, right? Now by looking into the utilization over a period of time, you can actually make out how is it that the borrowers, whether there has been any significant change in the behavior of the borrower. Let's say for example, if I plot utilization over a period of time, Suppose I have my utilization over here on the y-axis, and I have you and time on the x-axis. So this is my time. And you have utilization over here. Utilization. So over here, say you'll generally see something like this. So you can generally expect to have a periodic spike in the utilization graph, because now say if I were to talk about it in India, if I talk about an Indian consumer, there would be around multiple spikes occurring at a very seasonal level. Now, one season will be the festival season, which is through which we are presently going through now, because now credit cards would be used more frequently or with more volumes, but the payment will be done like 1 month later, right? When you have relatively more amount of cash in hand. Or there can be borrowers who go delinquent for one cycle and then they repay it back everything in the month of Jan, right? So over here, what happens is that in these last 2 months, like the expenditures generally tend to flush in. They tend to spike up, right? And the payments generally tend to be relatively lower. However, there is another important season where these tend to spike up, which is the marriage seasons. During the seasons of marriage, right, mostly what we will see is that the thing generally spikes up, right? So basically, you'll have because during that time, new marriages happen as well as the older marriages complete their anniversaries, and hence the overall spending of the middle class or among different class of consumers tend to go up. So you generally expect to have seasonality in the behavior or displayed in the utilization of the cards, right? Now if you see some seasonal spikes, regular seasonal spikes occurring in the behavior of an account or of your portfolio or of a segment, you need not worry if they coincide with the respective seasonality or the respective seasonal times. However however if you see that the spike is always high on the higher side, I mean utilization is always on the higher sides, right? Or there has been a distinct change in utilization after a period of time, or a distinct change in the payment pattern after a period of time, that is where you need to worry. Now utilization always gives us on one side of the picture. It shows us how is it that this borrower has been using his card, how what is his propensity for the particular line of credit that he has taken. Now in order to capture the riskiness associated with credit cards, we also need to look into one more point, that is the payments which the borrowers are making. The payments, now payments are an important characteristic which would give me an idea about, or which will help me finally capture the willingness of a borrower to pay back. Now utilization shows the extent to which they utilize the cards, and the second thing that we have over here is the payment balance ratio. I have the payment balance ratio, which is equal to the payments made over a cycle divided by the balance outstanding in the end of the cycle. So how much of the balance which was outstanding at the beginning of the cycle, how much of that has been paid by a particular borrower, right? So this shows the willingness. Now, if you take these two parameters together, what you will get to see is, you will get to see that this is a perfect case, or they together will help you explain the willingness of the borrower to pay back. Now these two taken together give you an idea about the willingness to pay. About the willingness to pay. Right? Now, how is it that I can explain this willingness to pay? Now, let's consider case one. Now, so over here, what we have is time. And I have utilization over here. Right? Now, what will happen is, say this is how your utilization graph looks like. So your utilization has increased more or less very steadily and but gradually over a period of time. Now your utilization, so this is what your utilization is, right? Now your payment balance ratio is something which is very close to this graph. Now if I look into this particular state, or if I look into this, I can see that the utilization is increasing, but the willingness to pay back is very lower. I mean, it's very low compared to the willingness to consume, right? So therefore I can say that this borrower has a low willingness to pay. Has a relatively low willingness to pay. Right. Now similarly, let's consider another case. Now what I do is, I have my utilization. Let's say, so this is the utilization of the borrower. So this blue graph represents the utilization, and the payment balance ratio for this guy is something like this. So what I can see over here is that this borrower has a relatively higher willingness to pay, because his willingness to pay is much closer. I mean, it lies very close to his the willingness his utilization graph. right? So say suppose if his utilization is 80%, out of that 80%, he's always paying back nearly 60% or more. So from that perspective, this borrower has a higher willingness to pay. So now when I use these two derived variables, the utilization and the payment balance ratio, and I look into them closely, I get to see that they have a high willingness to pay. Right. So this is high willingness to pay. So over here, what we have is the low willingness to pay, and what we have is the high willingness to pay. Right. So borrowers who have a relatively higher willingness to pay are the relatively less risky borrowers. So the variables must be so designed which would give us an idea about how you know how high or how low is the willingness the borrowers to pay back their dues, right? So I'll take a quick pause over here and I'll take up questions if there are any.
No, Tanmay. But could you please give an example of like the way you have given for credit cards? Can you pick for like secured product like mortgage?
For mortgage, right? Now for mortgage, the willingness to pay would be a bit difficult because I would not like, for a unsecured product, right, or for a revolving product mostly, I can capture it like this. However, the game is quite different from for mortgage products because number one, the mortgage products are backed by a security. Second, it's a fixed term payment. And the
Okay.
third is that mortgage products tend to have relatively less risky or risk of discount. I mean, relatively less risk of defaults compared to these unsecured revolving credit products, right? So the willingness to pay, so willingness to pay for mortgage products can be identified through missed out installments. So the number of times you have missed out your installments over a period of the last 12 months, over the last 6 months. So variables like this, or changing the or your what should I say? Okay, just let me reframe this. Just let me reframe this. So give me some time, right? Because I have not worked on mortgages too much, so I don't have that distinct idea about mortgage variables. Just give me today's time.
No
In
issues.
tomorrow's session, I'll get back to that.
No issues, Tanmay.
Okay, so I just get back to that. Get back on that view tomorrow.
Thank you.
But for mortgages, it would mostly be variables like loan to value ratio, number of missed out installments, month on books. So variables like this, which will give you an idea about the borrower's willingness to pay back. But more distinctly, this willingness to pay back can be captured for revolving products. Also, for secured products, right? Even that even if the guy is not going to give me back the money, I have the mortgage held with me, right? Which I can sell off and I can return, get back my money. And also, I have already charged my LTV against that. So I'm always kind of uh, like insulated against that. So the willingness variables would not be that distinct for a mortgage as it would be for a credit card, right? But anyways, I just look up a mortgage data or I look up some mortgage variables and I'll get back to you on that because mostly I have worked on the unsecured lending products and commercial products. So I have not had a chance to work on mortgage per se. So just let me look that up and get back to you. right? Great. Okay, so just give me 2 to 3 minutes time. I'll just have some water and I'll be back. Okay, let's take a 2 to 3 minutes break and we'll get started again. Or let's take a 5 minutes break to be to round it off properly.
This conference will now be recorded.
Okay, so as I was saying about this part, right? So we were talking about the credit cards before we took the break. Now, so basically, we one at a behavior stage, So any business, any retail product, for any product, what you are trying to actually assess is the willingness of the borrower to pay back, right? Or also, you are trying to understand any repayment patterns which may have changed from the point the borrower has started repaying back and so on. So you would, if you observe each of these variables, if you observe these, right, you'll see that at a behavior stage, or at this stage, we are looking more into the behavior traits of the borrower. How is the borrower behaving, right? So this is where this behavioral tendency comes into play, or these the behavior scorecard comes into play. Now, for retail, for credit card products, so I'll talk about this in terms of credit card, and the application scorecard was discussed in terms of term loans, because the two case studies that we'll take up would be in terms of these two respective products, right? So similarly, when we start working with the Basel models, the Basel models will be developed in terms of these two products, in terms of term loans as well, right? So mostly our focus on the Basel side, our focus on the scorecard side would be concentrated, or would be constrained to the retail sector more and more, right? But when we start talking about IFRS 9 or products like that, or regulations like that, that is where we'll rope in the commercial side of the story as well. Right? So let's get started over here, right? So over here, a few important variables that we need to look into, that a behavior scorecard for credit card uses, are as follows. So some of the important variables is something which I have actually identified over here. So I'm starting off by talking about. Guys, just give me a moment. Hey, hi guys. Yeah, I was on mute. Sorry, there was something at the door, so I had to. Okay, so as I was saying, so so over here, so the business problem that we have with us is that there is a person, Mr. A, who is a salaried guy, right? And he has come asking for a credit card with a limit 50,000. Okay, so I just take a pause. Pradeep, can you just be on mute? There's some background noise. Thank you. Yeah. So I have a so the business problem that I have with me over here is that there is a borrower or there's an applicant, Mr. A, who is a salaried guy, and he's come asking for a loan or a credit card with limit of 50,000. Now, oh sorry, he has been given a credit card worth 50,000, right? Now, the banks the bank needs to take certain account management decisions. So So account management decisions of banks include, so if I think about the account management strategies, so there are different account management strategies, right? So what are the account management strategies that we are talking about over here? So the account management strategies are strategies like, credit limit increase. Then you have uh, things like credit limit decrease. Then you have card blocking exercises, card blocking, or providing any other specific offers on cards and so on. So these are some of the important functions that this particular exercise or this particular bank or this or that is done with the account management teams. So that's the strategy team. So how much of an increase should I give? So should I give a 10% increase, 25% increase, 50% increase, or no increase? Should I reduce his limit in return and so on? So now, generally, when I'm trying to decide on this account management, or when I'm trying to take these account management decisions, right? So where I'm trying to decide on the quality and the quantity of the secondary line of credit, what I'm trying to essentially do is I'm trying to understand how these things are actually working, right? So over here, I have a credit limit increase, I have a credit limit decrease, card block exercise, and all these stuff, right? So I want to know that whether a borrower is a good borrower or a bad borrower. So how likely is he to pay back my dues in the next 12 months, or what are his chances of going bad in the next 12 months, right? So is he a good borrower or a bad borrower in that sense? Now, for doing that, my scorecard has four or five important variables. It has four important variables which we believe would help us in capturing the willingness of the borrower to pay back credit. Right. Now, over here, if you look into this, the question that comes out is why only these four variables? Now, there can be other variables as well, right? So it is not necessarily that I mean, the variables are these four variables per se. But generally, when we see that, when we develop the scorecards for credit cards, it is generally seen that these variables or some variates of these variables become the most important variable. So generally, we start from a set of some n number of variables and finally zero down on a set of important variables. How we do that? That is the question that the modeling processes would actually talk about. But over here, what we are trying to do is we have said, so what we are considering over here is that the model is built, and these are the four variables that we have selected out. Now, when the variables are being selected out, now one thing is obviously we assume that they are statistically significant. Also, they must have the necessary business justification, right? They must also have they must have the desired pattern of the behavior, desired behavioral patterns, right? Let's look into the first variable that's called the month on books. Now, what is month on books, or why is month on books of a borrower important? Now, month on books shows the vintage of the borrower. And for behavior scorecards, be it for secured products or be it for unsecured products, is unanimously the most important variable for a behavior scorecard, or it's the most important behavior variable, or the variable which explains the behavioral risk. So what is this month on books? The month on books generally show that month on books generally show the vintage of the borrower on the books of the bank, right? So this shows the vintage of the borrower on the books of the bank. And it is seen that greater the vintage of the borrower on the books of the bank for that particular account, lower are his chances of going bad. So this is where the vintage of the borrower comes into play. Vintage of the borrower. The vintage of the borrower, right? Now, this vintage of the borrower, so what is the month on books? Month on books is defined as on date. So the date when I'm evaluating the or calculating the month on books, it is as on date minus date when the account was opened. The account opening date. Now this variable turns out to be significant for most of almost all retail portfolios, right? So it can be your credit cards, it can be your mortgage, it can be your auto loans, it can be your personal loans. Month on books is a very important behavioral variable. It is very important to assess because it is seen that generally after for retail portfolios, it is generally seen that after your borrowers have been performing for a given period of time, after a certain point of time they mature to the extent that they hardly have any chances of defaulting. They hardly do default, right? So that is where this concept of month on books, or that is where this month on books becomes important. In fact, when we are doing Basel model exercises, right, we require to analyze whether the accounts that we are using for our model development are seasoned accounts or not, right? So whether the accounts have seasoned or not. So over there, what we do is we do the seasoning analysis. In the seasoning analysis, what is done is the following: we plot the month on books on one side, right, and the month on books on one side, and we plot the bad rates or the default rates on one side. Now what we see is, so over here what we have is So this is where, we see that after a point of time, right, the bad rates stop peaking, and the bad rates start falling. So you know that once your accounts have survived up to this critical point in the month on books, right? You know that your account has matured, and if it has not defaulted within this interval between, say, up to this MOB cutoff, you know that there is a very low chances of default going forward. So that is where the seasoning analysis is done, right? So mostly a retail portfolio, be it your auto loans, be it your mortgages or whatever, it is generally seen to season between 12 to 18 months of vintages. 12 to 18 MOB, right? So it is generally seen that the accounts mature within 12 to 18 months on the books of the bank. Sorry, on the month on books that the borrower has been with the bank. Therefore, higher MOB is associated with lower chances of default, right? So if you go to Basel and if you visit the retail portfolio section especially, you will see that it talks about the age of the loan being an important predictor of the riskiness of the loan. Also, similar analysis is also prescribed under the CRD guidelines, the Credit Requirement Directive, the CRD4 guidelines for assessing retail risk, right? So this is a very important variable for PD models, be it your behavior PD models, be it your Basel PD models, whatever it is. This is a very important part, right? So over here, the next thing that we need to understand, the next thing that we need to look into is that how whether you know so the next thing that we need to look into is that how does this variable feature into the scorecard, and how is it is used to score the borrowers, right? So over here, what we get to see is for month on books, it is divided into four categories. Now, the next question that we ask ourselves over here is how do we create the categories? So we create these categories based on the weight of evidence, right? So what is the weight of evidence? The weight of evidence it's a transformation which is done based on the log of odds, right? And that log of odds is again used in scoring. And all these will be discussed when we enter into the variable selection proportion of model development. So all these parts, why these four categories of the variables, how are these score being generated? So these are the factors, these are the questions that we would be answering once we start working with the model development exercise. So we'll be actually talking about a whole full-fledged variable selection approach where we generally look into how is it that how is it that we would move across categories and create certain scores, right? So basically we would be talking about those model development exercises in so how is we start from a whole set of 1,000 variables, and how is it we reduce to these four variables? So that is again that we would be discussing in the later stages, right? So over here, what we are trying to do is we are trying to understand how is it that they are deployed. So how would a behavior scorecard look like, and how is it I can use this behavior scorecard in my risk management strategies? So over here, the month on books, so the seasoning of the account is gradually discussed in terms of four categories. Categories which are less than 6 months, between 6 to 12 months, between 12 to 24 months, and more than 24 months. And we see that as we move across, right, a borrower keeps on getting a score. So now, say suppose there is a borrower who comes up asking for a credit limit increase. Now, I want to know what are his chances of being good or being bad. And I see what is his month on books. He's just been 3 months or 4 months on the books of the bank, right? So the scores over there is zero, right? Now over here, what we have is the month on books. So I will give a score 0 to a borrower who is less than 6 months on the books of the bank. Now, borrowers who are 6 to 12 months on the books of the bank get a score of 15. Now, over here, the score is though given arbitrarily, but it is derived from a equation of the log of odds, right? And from there, we decide on the scores. So between 12 to 24 months, it's 22, and greater than 24 months, it's 29. So what I get to see is that on the month on books, on seasoning of the accounts, right, I have the scores like this. Now, one thing that needs to be taken into account is that the scores must either monotonically increase or monotonically decrease across the weight of evidence scenarios, right? So what we get to see over here is that as on date, so basically month on books is nothing but the difference between the as on date and the date when the account was opened. It shows the vintage of a customer on a particular account with the bank. A borrower with a greater vintage is seen to have lower chances to default, and typically in a retail portfolio an account takes around 12 to 18 months to get seasoned. So this is precisely what the framework is, right? Now, the next part that we go in to talk about over here is, so what we see is that as the vintage increases, I keep on giving a higher score. So higher the vintage of the borrower with the bank, the higher would be the score assigned to him, right? Now let's move to the next variable. So month on books is a variable which gives us an idea about the seasoning of the accounts, right? So now if you want to talk about the seasoning analysis, as I was saying, I had made a note of seasoning analysis over here, right? And we have seen the default rates, like, and what we have done is we have plotted that as well, right? And what we can clearly see is that after 12 months onwards, the bad rate gradually falls down, right? Hence, sorry. Okay, I'll just yeah, so this is the cutoff point, right? So from here I can see that after 12 onwards, the bad rates are actually falling. So now this is I have done only for 1 month, but generally for identifying the cutoff, what we do is we do it for many multiple months, right? We plot the month on books, and basis the month on we find out how many accounts are defaulted, and then what happens is we generally, so after we have done it for multiple months, we put the results on top of the other, and wherever the maximum switchovers happen, that is identified as the cutoff period, right? So this is precisely how this thing is done. So that's what seasoning analysis is, and that is why the month on books needs to be a very important factor. Now, apart from this, so the next variable that I that find that becomes very important for a behavior scorecard is your percentage delinquency in the last 12 months. So in the last 12 months, what has been the percentage, or how many months has the borrower been delinquent the last 12 months? So that is what we need to see over there, right? So now when we see it over there, it looks something like this, that so delinquency variable is something which is important. So what is delinquency? Delinquency is the event when a particular borrower misses out on a payment, right? So if the borrower has missed out paying a particular due, then that is a delinquency. I mean, that is a event of delinquency, right? So let's say percentage delinquency in the last 12 months. Now, what do I mean by that? So it means that, say, in the last 12 months, so there are two borrowers, A and B, right? Now, borrower A in the last 12 months has been delinquent twice. So his percentage delinquency is 2 divided by 12 into 100, right? So he has been delinquent like something more than 10% or something like that. So it's like 1 and there's it's 6, right? So out of, so like for 3, if it's been for 3 months, it's like it's 25%, right? So this is going to be less than 25%. So it's like uh, 16 point some percentage that the guy has been delinquent. So his percentage delinquency in the last 12 months is 16%, 16 point some percent, right? Huh. So it's 16 point some percent roughly. So therefore, one thing that we can see over here is that this higher the percentage delinquency of a borrower, say out of the 12 months, there is a borrower who has been delinquent for 6 months in gaps, 2 months, 2 months, 2 months, like this, right? So that borrower is obviously a higher risk borrower because he has been for the 50% of the months, the last 12 months, he has been delinquent, right? So what I see over here is that as the percentage value increases, so as less than 10%, so if your delinquency in the last 12 months was less than 12%, then you are the safest borrower I can think about. So it gets the highest score. If it was between 10 to 25%, it's 37. It's between 25% to 50%, it's 30. More than 50%, it's 0. As simple as that. So you see that as I move across, right, across the categories of this variable, I am actually, what I'm doing is I'm ordering the risk that a borrower has. So say for example, a borrower who has been less than say who has been uh, into the books of the bank for more than between 6 to 12 months, or say 12 to 24 months, right, gets a score of 22, but this guy has been delinquent for more than 6 months, gets 0 score for the second. Or a guy who has been less than 6 months on the books of the bank and has been delinquent more than 50%, right, in the last 12 months, so that borrower will be getting scores 0 and 0. So there he's getting nothing out of it, right? So therefore, you can see that the more risky the borrower is, the lower will be the scores associated with the borrower, right? Now, say a borrower who has been, say, let's consider two borrowers, less than 6 months, right? So both of them get scores 0. Now there is a borrower who is less than 6 months on the books of the bank and has a delinquency rate of, or has been delinquent more than 50% or 50% period of time, right? So he gets a score of 30. Now a borrower who is less than 6 months on the books but has delinquency less than 10%, it gets a score 45. So you see that given that two borrowers have similar risk characteristic in terms of one variable, say in terms of month on books, the second variable, delinquency variable, helps you distinguish who is a better risk borrower, who is a better borrower, and who is a less risk and who is a more risky borrower, right? So this is the advantage that scorecards have in assessing the behavior risk, right? So after this, the next part comes in average payment balance ratio in the last 12 months. So one thing, if you see over here, the delinquency in the last 12 months shows reflects the behavioral risk. So does month on books. Both month on books and delinquency, they reflect the behavioral risk. So higher, or they reflect factors which capture the behavioral risk, right? Now, say let's go into the next 12 months. So the average payment balance ratio in the last 12 months. So borrowers who have had higher average payment balance ratio, right, are those borrowers who have been, I mean, who uh, have higher willingness to pay back. So as you can see, both of them are increasing, right? Both of them are increasing. So as you move across the categories for this variable will give you a clear idea about who has a higher willingness to pay back. The borrower with a higher willingness to pay back is always a better borrower and hence is given the greater score. Right now, suppose the last two variables gave you did not help you distinguish between two borrowers. Say both the borrowers were greater than 24 months and had hardly any delinquency in the last 12 months. So both of them had scores of 74, right? Now it is this field which will help you identify. So average payment balance ratio says for one borrower lies in 28. Say he pays back between 50 to 75%, and there is another guy who pays back more than 75%. That will give you an idea. So given that if the borrowers were similar in terms of riskiness for in terms of other parameters, the borrower with a higher average payment balance ratio will be the low risk borrower, right? So given everything else remaining unchanged, if a borrower has a higher average payment balance ratio the last 12 months, is considered to be a better borrower, right? So in that case, so this is how this thing goes, and this captures your willingness of the borrower to pay back, right? And the final variable that we have looked into is average utilization the last 12 months. It need not necessarily be these last 12-month variables. I've used it for simplicity of understanding. Now generally there can be multiple other variables which can be worked around the same, right? Okay. So the next part that we have over here is the average utilization in the last 12 months. So you see that higher the average utilization is, the higher is the riskiness associated with the borrower. Okay, so over here you see that higher the utilization is, the when the utilization increases, the generally the percentage of utilization gradually goes down, right? It starts going down. So therefore, what we can say is that the average utilization in the last 12 months, the propensity of the borrower to consume credit increases. So higher this propensity is, lower is the score, right? Now, this why is this so? Because the propensity of the borrower to consume credit shows his uh, hunger for the credit, right? Now, let's come to the next part. Now, this is what the score cutoffs are, right? And we have seen that the variable that we have covered talks about the vintages, the risky behavioral risk of the borrower, the willingness to pay, the propensity of the borrower to consume credit, and everything. So we have covered all the riskiness. So is this description of the behavior scorecard clear to all of you?
Yes, Tanmay.
Okay. So
Yes.
what is most important, the reason I'm identifying this at the beginning is so that you know what type of variable should finally enter into your model. So when we are doing the variable selection parts as a part of the model development, you should be able to identify that, okay, these are the variables which are going in and they should go in, and these are the variables which are going in but should not go in. So when you get any significant or insignificant variables, you should be able to identify their business sense. That is why I am feeling the end at the first, and then we'll start with the model development so that you know what the conclusion is going to be like. So that will help you recreate the model in your minds when you are developing them. Now, after this, the next part is, So you have the business problem, right? Credit card, Mr. A. So Mr. A applies for the credit, had applied for the credit card, and he had limit of 50,000. Now what I want to do is I want to understand whether the borrower should be given a credit limit increase or not. So if he's going to be a good borrower, I'll give him. If he's going to be a bad borrower, I'm not going to give him. Now my strategy team has given me certain minimum score criteria. So what is the minimum score criteria that I have over here? So the minimum score criteria that I have over here is as follows. I have I say that the borrower's month on books should be minimum value. It should be between 6 to 12 months, right? His delinquency should lie between 10 to 25%. So that is, he must, at max, I am willing to allow him to go delinquent for 3 months, not more than that. His average payment balance ratio must be between 20 to 50%, and his 30 to average utilization should be between 30 to 60%. Only then I'm going to give him the credit. So these should be the basic criteria, and based on that, I have my minimum score which has been generated. Now what I do is I look into the borrower's introduction, the borrower's credential, Mr. A's credential, who's come asking for a credit limit increase. So over here, I say Mr. Month on, I see that Mr. Month on books, the borrower is 5 months. Now, if he is 5 months, the score that I get is 0. So this borrower is a very new borrower to the bank, right? So he has been using his card for the last 5 months, right? His month on books, he's been on the books of the bank for 5 months, and he has never been delinquent in the last 12 months. So throughout the last 5 months that he has been there on the books, he has not been delinquent. So therefore, if I look into his behavior of the last 12 months, his score is 45. Now his average payment balance ratio is 5%. So he pays back just 5%. So I at least require him to pay back 20 to 50% for him to get a credit limit increase. But his payment is relatively lower. So basically, it is just that what he does is he just pays back the minimum balance every month and revolves on the larger amount. So even though he is a very good borrower, he's a very prospective borrower for the bank because the bank can make a lot of profit from his account. But what happens is that since he's like 5 months into the books of the bank, therefore the bank does not take the risk of rejecting him. Now, doesn't take the risk of giving him a credit limit increase, because in case he defaults going forward, the bank may be at a loss. Right? So his average utilization is 35%. Now, yeah, so it is between the required perspective, right? So now when I add up his total scores over here, his score is 88. But the cutoff score over here was 102. Now the reason behind this is, now you see now if you look into this borrower's characteristic and you see why the bank has labeled him as bad and has declined him the credit limit increase, is because of the following reason. The first part is that this borrower is now for delinquency and average utilization is well within things, right? Now the problem that the bank has with them is the fact that he is a borrower who is just 5 months on the books of the bank. And how has he been avoiding his delinquency? He has just been paying back the minimum balance, which is 5% of the assets, right? So therefore what we do over here is that, so therefore given these two reasons, right, this is where the borrower falls short. And given that, I can say that yes, this borrower is not being given the loan, right? So the borrower is being rejected on the loan because of this reason, right? So therefore, what we can clearly see from here is that by manipulating so by setting your cutoff scores, you can decide the quality of the acquisition, the quality of the account management that you are going to do, as well as you can also help manage, monitor the quantity of the credit that is being flowed out, right? Now, if I have 100 rupees to lend, right, rather than lending 50 rupees to this guy and 50 rupees to a very good guy, I would rather lend that 100 rupees to the good guy, because I know that this borrower is still somewhat risky, because he has not been for on books of the bank very long, and he, even though he has not gone delinquent, he has been revolving on the loan amount very largely. Now, in case of higher limit increases, he may go and use more credit and then just keep on paying by the minimum balance. And in between, if some stress scenario happens where his repayment capacity undergoes a deterioration, the entire amount, the entire exposure would be at risk. And hence, the bank decides not to increase the exposure towards this particular account, right? So therefore, this is how the your behavior scorecards would be used for your secondary line of credit, which is nothing but your respective account management strategies, right? So is this interpretation clear to you? Is it clear to us?
Yes.
Great. Great. So the next part that we talk about is, so how is it that credit limit increases are used? Uh, you know, where behavior scorecards are used. So behavior scorecards are used not only to identify the good or the bad borrower in the next 12 months, right? They're also used for other purposes, right? Because based on this behavior score that I have, right, what I'll do is I can decide on the credit limit increases. So whether to give an account a credit limit increase or not, if yes, how much to give, like what should be the interval, right? If not, should I give him a credit limit decrease? If yes, if a credit limit decrease will be given, then by how much should it be given? And finally, behavior scorecards are also used to manage secondary line of credit during downturns, right? If there is a downturn in an economy, what I'll do is I'll just go back and change my minimum criteria, and I raise this score from 102 to perhaps a 122, right? So that when this borrower actually comes in, so borrowers between 102 to 120 who are now 122 who are now getting the score, getting the credit, would be ruled out. Only after 122 onwards I would be giving them the credit limit increase. So I would be detoxifying my portfolio through this. So at acquisition stage, what I'm doing is I am preventing the primary line of credit from going out to the wrong person by raising my acquisition score cutoff. But over here, those borrowers who are given a loan under, say, a good situation, right now are asking for more credit. Now I can reduce, I can manage my second line of credit or my secondary line of credit using my behavior scorecard, right? So this is how scorecards help us manage risks at different stages. So basically, if I'm to think about it, basically scorecards help us ordinarily rank the riskiness borrowers according to their relative riskiness, right? And and this scorecard and they help us manage their credit risk strategies accordingly, right? So it helps us rank the borrowers at according to the relative riskiness at each stages, and thereby it helps us it helps a bank very effectively uh, you know very effectively channelize its quality and the quantity of the credit. So it helps the bank to optimize the quality and the quantity of the credit that they are lending out to ensure that the credit doesn't fall in the wrong hands, right? So these are the two broad scorecards that we would be working on for developing the acquisition scorecards. We will be talking about, or for talking about the acquisition scorecard, we'll be using a term loans data, and while talking about the credit card behavior scorecard, we'll use a credit card data set, right? So the variables finally that you will see would be something which is very similar what you have seen in these examples, right? So any questions up to this point? Great. Okay, great. Okay, fine. So So let's do something. Let's take a 5 minutes break and then let's get started again. So next when we come back, I'll be talking about the different stages of developing a scorecard, right? Then we'll see that how is it being done for the application scorecard, how is it being done for the behavior scorecard, what are the key deliverables and so on, right? So let's take a 5 minutes break and then let's get started.
This conference will now be recorded.
Okay, so welcome back from the break. Uh, so before the break, before we parted for the break, we looked into, we had a very quick synopsis of application scorecards being done, right? Then we had a discussion on the behavior scorecards, which was also done. Now, after that, the next thing, so we saw that how is it application scorecards and behavior scorecards are used in risk management strategies. And after that, what we get to see over here is how is it that the scope analysis, the next thing that we need to understand is that how is it that the scorecards are developed? What are the steps that I should follow in order to develop a scorecard? Right? Because the final result that we saw, and we saw how the application scorecard was used for taking respective business decisions, but at the same time, the question that comes out to us is how is it that we are going to develop this particular application scorecard, right? So this is something that we need to kind of understand. So in this respect, so before we move on, right? So, so if you have a look into the behavior scorecard features, right, you'll see that there were just four variables we had used. Now, the question that comes out over here is why only these four variables? Why not other variables? Why would I use only these four variables for my model development exercise? Right now, when I start off, I have thousands of variables. So when I have, so how do I drill down from these thousands of variables to these four variables, right? So that is precisely the exercise. So that is what precisely the modeling exercise would talk about, right? So let's have a very quick look into those different stages of model development that would come across. So before we move on, let's try to understand what exactly is this model development. What exactly is a statistical model, or what is a risk model that we talk about so much? Why is it that with this development, why is that we are so obsessed with this development? So what is this model? Now model is nothing but model represents causality. So model represents causality. Causality. And the causality is between what? The causality is between the dependent variable the dependent variable and the independent variable. So I have, so this over here basically what we have is, between dependent and the independent variables, right? Now what is the dependent variable? The dependent variable in a model is nothing but it is your target variable. It is the target variable. So target variable as in it is your, so for scorecards the target variable is mostly dichotomous in nature. So it is y equals to 1 if the borrower is a defaulter, equal to 0 otherwise. So y equals to 1 if defaulter, 0 otherwise. Right, so y equals to 1 if defaulter, equal to 0 otherwise, right? So for a target, for a dependent variable, right, for a dependent variable in a scorecard, it is essentially a dichotomous variable, right? And what is the independent variable over here? The independent variable over here are the risk drivers. So it is the risk drivers. So what I have over here is the risk drivers, right? So what are the risk drivers? The risk drivers are nothing but explanatory variables. So which can be the primary variables or primary explanatory variables, as well as they can be derived variables, or they can be, derived covariates, right? So this is precisely what we have over here, right? One we can have a primary variable, we can have a derived variable. Also, what we can have over here is a risk driver or a primary, a kind of a risk driver. This is a primary or derived variables. So now the question that comes out over here is that how to develop this model, how to develop a model, right? The question that comes out over here is that, yes, how do you plan to develop a model? That's the biggest question. So what are the steps of doing so? So the first and the foremost step of developing the model, right? The first and the foremost step of developing the model is what? So what do you think should be the most important step of developing a model? Anyway, it's Harish, Pradeep, Piyush, anyway. Yes. So what do you need to do first before you start developing a model?
Data understanding.
No. So
Okay,
that comes
then the
later. That comes later. But the first and the most important thing.
what is the objective of building the model?
Correct. Defining the scope of the model. And the second is you need to, or the most important part is you need to actually kind of engage your management into believing that the model needs to be developed as a project. Because if you think about the business, for the business, a new model is an additional cost. Now, they would only be willing to develop the model if they know that there would be a substantial corresponding benefit corresponding to the uh, you know corresponding to the cost that it bears for the model. So if I am trying to develop a model, right, now my management will come and tell me that why do I need to develop the model? Why would I develop a new model of when I already have one? So that is where you need to justify to your management that yes, this is the reason why you need to develop the model. The present model that you have is not working fine. So your before you start developing a model, the first thing is there are two possibilities. One is you don't have a model at all in place. So there your job is to justify to the business that the way you are actually lending without the model, right? You are entering or you are incurring something called an adverse selection. So that is you are having more of risky borrowers than good borrowers. So your credit is qualitatively getting if it channelized to the wrong borrowers. Now with this model, you'll be able to better streamline your lending activities. That's one. The second, which is more applicable for a large bank, large bank kind of a framework, like HSBC or something, that you need to actually tell your management that see the model over here that I have with me is dwindling. It's the model is not working fine. So there is certain problem with the behavior of this particular model, and hence this model needs to be redeveloped. So then the management may respond by saying that okay, there is some problem with this model, right? So why don't we recalibrate this model and we see go for a more of a recalibration or realignment rather than a full-fledged redevelopment. So to that, you need to justify that with this model, your portfolio delinquency rates are increasing. So after since this model has started doing new the last 1 year, the delinquency rates across the buckets have increased, and that your portfolio has become inherently more riskier, and therefore you need to actually go ahead and redevelop this model. So that is where the concept, that is where your first part of model development comes in. You need to get an approval. You need to get uh, you need to justify that there exists a gap. You need to perform a pure gap analysis. From there, you need to justify that yes, this model needs a redevelopment. All right. So the first exercise that we need to do, or the first step of any model development exercise would be a scope analysis. Would be a scope analysis of the data. Scope analysis and gap identification. and gap identification. Right? So this is the first and the most important part of any model development. Now, once this step is cleared out, only then can you go ahead and you see that, okay, this is how the model needs to be developed. Then data extraction begins, identification of variables begin, creation, and all the subsequent stages, they come one after the other. But the first and the most important part that you need to do for any modeling exercise is your scope analysis and gap identification, through which you need to do a cost benefit analysis and you need to show that redeveloping the model and re-implementing it in a fresh way will serve the purpose or will help the bank make a better business out of it in the long run. Only then will the bank be willing to bear that particular cost. Right? Now, this is very true for your BAU models or your business as usual models. For regulatory models, they have to be developed, they have to be monitored, and if they dwindle, they have to be redeveloped. So that's a different story altogether. But for business as usual models, you need to actually ensure, you need to support the bank and tell them, man, this is the reason as to why this problem is happening. Right? And hence, this is why the model needs to be redeveloped. Clear? Any questions on this part?
No.
Okay, great. So guys, let's take a pause here for the day. Tomorrow we'll start off with by a detailed description of the scope analysis, gap identification, and then we'll go take up the following successive steps, right? And then once we have gone through the steps end to end of model development, after that we'll take up one case study at a time. We start with the application scorecard case study. There are three phases of its development. First is a base model development, followed by reject inferencing. The third is a full-fledged acquisition scorecard development, followed by uh, that will come to the behavior scorecard and then gradually to the Basel models. Clear? Great.
Yes,
So
Tanmay.
let's meet up again tomorrow, 8:30 a.m. Right? And then let's take it up from there. Thank you. And tomorrow from 11:30 a.m. I have the IFRS 9 session beginning. So those of you who are interested in joining the demo sessions for the first two classes, 3 hours each, can join in from tomorrow. Thank you.
Sure. So, Tanmay, just a quick question. The IFRS 9 session is also a 3-hour session, or is it a 2-hour session?
It's like the gross time is 3 hours, right? But
Okay.
if it starts from 11:30, right?
Mhm.
Uh, I believe it's going to finish by 1:30 or 1:45, because like taking it for 3 hours, three constant hours may be a bit of a challenge, right? But
Okay. Okay.
going forward, I will try to make it a 3 hour session because it's only one day a week.
Sure. And the CRM sessions are every day.
CRM sessions, I have planned it at 3 hours, but I believe I'll cut it down to 2.5 hours because taking it for 3 hours may be a bit of a challenge.
Sure. And these sessions are done every day, or is it just weekend for CRM?
Saturday and Sunday.
Only Saturday. Okay. Thanks. Thank you.
Yeah, thank you.
Thank you.
So I have a weekday batch also going on, but that's at a different part now. Okay. So this batch is a relatively fresh batch and which is started right from the scratch. So this is the ongoing batch. The weekday batch is going to end around somewhere around Jan, and after that I'll enroll for the weekday batch of fresh. Okay. So let's meet tomorrow and then let's take it up from there. Thank you guys. Bye bye. Have a great weekend.
Thank you.
Thank
Thanks.
you. Good day.
Thanks. Good day.